Hello everyone, how are you? I'm Dr. Lavi from Dr. Lavi's Academy. Welcome you back. Hope you are doing well. Okay, today we are going to have uh, things related to ACCA SBR. Okay, this is professional level paper, and we are going to cover in continuation with the series. Okay, before we have 15 lectures, this is the 16th one. Okay, 16th one of the 25th series. Okay, this is very important. Please follow these things very closely. I kindly request you all to please subscribe to my channel, share my channel, watch till the end, and whoever is going to known people who are planning to write ACC exams, please share this channel with them. And in the end, put your comments, anything, anywhere, just let me know. And share this channel, and hopefully if you'll find really value added one, please like this channel. Okay, so I kindly request you to subscribe to my channel and follow the things as such. Okay, we are talking in terms of lease, how the lease accounting will work, is right, in financial accounting, financial reporting. What we are going to do is we are dividing this. I am following Kaplan and in the same sequence. Okay, this is the Kaplan. Discuss and apply the lease. What is the concept of lease? That's the most important thing, is it? When we are talking in terms of, when we cover in terms of lease, nowadays every other business, they don't wish to own. Okay, they don't wish to own asset, as simple as that. What they will do, they will take it on a lease. The same thing they can use in the same financial resources they can use in their business activities, and for a long term. And instead of that, what we'll do, we take the asset on a lease. Okay, and we generate revenue from that asset, and in between we will pay it back. Is that we will pay it back to the lessor. Okay, so that is the most economical way. It is that we don't know, because what happens in most of the cases nowadays, that things are changing very fast. Okay, when the things change very fast, we don't know what is the technology we are going to have. Technology will change very fast. Okay, the market conditions also change very fast. Okay, the market conditions, the demand, okay, the demand for the product, likewise the locational factors, everything will change very fast, and nobody wish to have a commitment for a long term. Okay, they will have a short term commitment based on that. The most important thing is, what we'll do, we always take into consideration what is the cost and what is the benefit. We will use the word, this is what we will very much clear about how best it will be economical. In this context, we are going to understand the concept of this. It's one of the questions which will be there in the examination for almost 6 to 8 marks. Is it right? 6 to 8 marks. Maybe they will give in section B. Okay, they will give in section B. I'll put the points. Is that discuss and apply the lease accounting requirements. What is the concept of lease? And most importantly, here we are using this one. Okay, what is the right of use of asset and liability? That this is very, very clear. What is the right? On what? See, we are taking it on a lease. Definitely, we will not have a complete ownership. We have a restricted ownership in the use of the asset. That we will discuss in detail. Describe and apply how the accounting procedures will be for lessee by lessors, and circumstances in which there is any remeasurement. Is that means sometimes what will happen in most of the cases, if you take into consideration, they will say that the lease is going to be 99 years maximum. Okay, the lease is going to be 99 years maximum. Now what happens, you cannot have the same terms and conditions at every time, is it right, for 99 years. What we'll have, we'll have a short term agreements, is it right, and it is going to be, again they will have a remeasurement from time to time, is it right, from time to time. This is the second point, this is the third point. Okay, the fourth one is discuss and apply the reasons behind separation of what are the, when you are saying it's a lease, we have to make it very clear what are the components of a lease contract and what are the non-lease elements. What are the lease elements and what are the non-lease? We'll cover in detail. This is the fourth one. The fifth one is the recognition exemptions under current leasing standards. To discuss the recognition, how we are going to have, what are the exemptions we will have whenever we are talking about the lease. And the next one is discuss and apply the principles behind accounting for sale and lease back transaction. What will happen, sometimes we are taking it on lease, okay, we are taking the asset on a lease, and subsequently at the end of the lease there will be a sale, okay, sale of the asset. Is that, if that case, how we have to think in terms of accounting. Fine, is it? These are the 6 major points we are going to cover. It's a level 16 series, and mostly I will take it in 2 sessions. Okay, I will take it in 2 sessions. What we are doing, we are talking about identify what is the lease accounting, is it right? Identify the lease, how the lease accounting will work, how lessee accounting, and how the lessor accounting, and what is the process in terms of sale and lease back. It says very simple, take it a point. Most of the content chapter is, we have, whoever have done financial reporting, is right? In financial reporting we have done basic elements of this. Exception was what? Lesser we have not done, with the exception lesser accounting we have not done. Entities might attempt to under report lease liability, so this is the area of audit risk. Is that whoever is going to have advanced audit and assurance, whether we are going, one of the things they will ask is in terms of lease liability. Coming back to the things, what it says, see, IFRS 16, this is very, very important. IFRS 16 talks about the lease, okay? IFRS 16 talks about lease, providing the definition. What is the lease? A lease is a contract, a part of the contract, a part, okay? Part of that conveys the right to use an underlying asset for a period of time, is right, in terms of exchange of consideration. And when we are talking about the consideration, definitely the consideration will be in the form of cash only, okay? The lessor, this is the lease agreement. It is a contract, okay? It is a contract that conveys the right to use an asset for a period of time. Lessor is who provides the right of use an asset in exchange. It means lessor is practically, lessor is the person who owns the asset, okay? And lessee is the entity that obtains use of asset and exchange transfer consideration. Is that the person who is going to use he is the owner and he is the user. A right of use asset is the lessee's right to use underlying as per the what they will very, very clearly say, as per the lease term. Is that a simple example? Okay, a simple example I will say. People will take car for rent, okay? People will take car for rent. They will take car for rent on daily basis. Sometimes they will take car on rent on monthly basis. Monthly basis or they will take on a half yearly basis, or they will take on a yearly basis. If that is the case, definitely they will look into the things in a more detailed way. If you are taking on a rent, definitely it is on a daily, very short term. But if you have a agreement to write a use, in both the cases you have the right to use, but the conditions, the situations, the circumstances will differ. In this session we are going to cover how the lease accounting or the lease right of use of asset is critical for us. What IFRS 16 lease requires lessee, the person who is using the asset, to recognize an asset and a liability for all. See, when you are taking an asset on a lease, you have to pay consideration. Okay, a lessee will pay consideration to the lessor. For the lessee, it will be a liability, is it? Unless there are short term or minimal value. I told you about the rent. Okay, rent is very short term or minimum value. As such, it is vital to assess whether the contract contains a lease or it is simply a contract for service. First, you should identify. That's very important, isn't it? The first thing that matters to us is to identify whether the contract is of lease or the contract is for a very short term service. A contract contains, here we are very clearly mentioning, what is the lease contract says? The right to control the use of an asset, identify asset for a period of time. See, you should have the right to control. When you are taking an asset, is it right? You should define, is it right? The lessee should, is it right? Should have the independence, is it right? Should have the independence to define, okay, the terms or conditions of for the restricted period, okay, to define the terms and conditions, is it? And conditions, is it? Within, see, very clear, within the respective framework, is it right? Is it right? By lessor, is it right? By lessor. That's whatever the lessor will say, whatever the lessor lessee agreed, within that framework only you can work it out. We cannot say that we can use something which is not within the understanding. Means we should not override the rules and regulations of the contract. The customer controls the asset. When we are controlling the asset, when we have the right, the right to substantially all the identify assets economic benefit. See, when a lessee, is it right? When a lessee takes an asset on lease, definitely he will generate revenue. That revenue belongs to whom? Belongs to the lessee. That's very specific. Lessee in turn, is it right? Lessee will in turn will pay to lessor, is it right? Will pay to lessor. But the revenue, whatever is generating, the lessor will not have any control on the revenue. Who will have control on the revenue? The revenue is going to have the control with the lessee. That's very specific. Okay, the right to substantially all of the identify assets economic benefits, and the right to direct the identify means I told you just now, is it? I told you just now, within the framework, okay, within the framework, is it? Within the agreed terms and conditions. Okay, within the agreed terms and conditions, the lessee can use the asset. That's why we call it as a right to use, is right? Right to use. We should have, when we are taking the, there should not be any restrictions. You are taking a a house on rent, okay, a house on lease, okay, then they cannot put any condition that you should come this time, you have to go this time, this much. No, when you are taking a house on rent, flat on rent, you have the rights within that period as such. The right to direct the use of asset can still exist if the lessor put conditions. In some cases, the lessor will put some conditions, okay, or limiting conditions or its use within the contract. If there are any conditions are there, okay, if there are any restrictions are there, is that it has to be, these restrictions has to be communicated, okay, this has to be communicated, okay, communicated at the beginning. Is it? This has to be communicated at the beginning of the contract only, that you should not use this, you should not do any major restructuring within your within the asset specifications, okay, such as capping the maximum mileage of vehicle or limiting countries' assets can be used. See what happens. You are taking a car on lease, okay, we are taking, what they will say, usually they say that you should not drive more than 200 miles per day, okay, you should not drive 200 miles per day. They'll say that you should not go, they will say that within the restricted country you can travel, okay, within the country only, you cannot take the country, and you cannot visit the other travel to other countries, cross border other countries, okay. Those are the things which can be, these restrictions defined. What is the restriction? This is otherwise called as scope of lessee right of use. They will not prevent them, but they will say that how you have to use it. IFRS 16 says that a customer does not have the right to use an identifier asset if the supplier has a practically ability to substitute the asset for a alternative if it will be economically beneficial for them. They say that customer does not have the right to use a identifier if the supplier has the practical ability to substitute. Means once you are giving it on the lease, definitely you should not change the terms and conditions, okay. Those are the things which you have to be very clear at the beginning. Means in between there is a flexibility in the lease contract, but only thing is, if the asset is not working, then there will be a replacement. But those things should be very clearly defined in the lease contract at the beginning of the period as such. Now here it makes more sense, okay. What it says, see, you divide it, that's what I will say. In the examination also you have to do this. Coffee Beans enters into a first sentence, okay, enters into a contract with an airport operator to use some space. They say it is a some space. We cannot say it should not be general, it has to be specific, to sell its goods from portable kiosk for a 3-year period. Portable kiosk means you can move from anywhere to anywhere, okay. Now, Coffee Beans owns the portable kiosk. The contract stipulates the amount of space and states that the space may be located at any one of the several departure units. Means they are not making a specific condition. They say you can put it any place as such. Is that the air operator what they say, the air operator can change the location of the, see what just now what we are doing is that does not says that the customer does not have the right to use the identifier if the supplier has the practical ability. Is it? This is what it says. The airport operator can change the location of the space allocated at any time during the period of use, and the cost that air operator would incur to do so will be minimal. Means you don't have a complete right, okay? We don't have the complete right over the use of the asset. In between you can say simply by saying this, we can come with a conclusion that whether it is defined as a lease or it is not defined as a lease. There are many areas in the airport that are suitable for the portable kiosk. Required, what it says, does the contract contains a lease or not? Is it that the contract contains a lease or not? Means you have to make it sure. Is that you have to make it sure. When you are doing this, is that you have to mention. I will write here point by point. Is that this is a contract is for the space in the airport. Is that and the space and the airport operator is that has the practical right to substitute. He can change the place. Okay, he can change the place during the period of use. Is that they say that there are many areas are there that meet the contract terms, providing airport have the practical ability. Means airport operator will say that you today you put here, tomorrow you put in other place, tomorrow you put in other place. Is that in airport we will see there will be a fixed place will be there. Is that space? Most of the time they will give space within the airport for lease, fixed place. But if you are changing the place all the time, definitely what will happen there you are substituting the asset for a alternative. Is it right? Now that's what it says. Who will benefit? Is that it is the airport operator who will benefit? Is it right? They say that cost is minimum fine. That's not the case. Is it right? If you are doing the things, he will change it from one place to another place as per the demand and supply. Okay, as per the demand, definitely he will give a premium place one day. Is it right? He will give a premium place one day. Is it? If there is no demand, and he will give some remote place. Is it right? On another day when there is a demand. Is it right? When means what happens? Definitely the owner of the asset is changing the terms and conditions. Is it? The owner of the asset is changing the terms and conditions. If these are the things, is that we have to write in the examination. This is very important. Okay, in the exam I will write this for your understanding. Is that the contract? Is that the contract is for space in the airport. Okay, and the airport operator has the practical, okay, has the practical right to substitute. Okay, he can change the places as per his will and wish. This during the period of use. Okay, because you have to mention the reason. See, SBR, you have to write what you are doing, as simple as that. Is it right? You are not going to do anything else. If you are doing calculations, you have to write those things. That's very important in scoring marks in SBR. Okay, in any fine. Now, what it says, what are the points? There are many areas. Okay, what they say, there are many areas available in the airport. Is that there are many areas available in the airport. That would meet the contract terms. Okay, that would meet the contract terms. They say that the terms will not change, only the place will change. Is right? Providing the operator. Okay, providing the operator with a practical ability, right, to substitute. They have the, see, this is what it says. We are working with the airport operator, and he has the right to change the place at any point of time. Is right? Now, in whose advantage is going, that's very important. Is that in whose advantage? It is not the advantage with respect to coffee bean. Okay, it is not in the advantage of coffee bean. It is in the advantage of the airport operator. Now, is it right? The airport operator would benefit. Okay, the airport operator would benefit economically. Is it? The lesser, who is the lesser here? Here the lesser is airport operator. Is it? Here the lesser is airport operator, and who is the lessee? Lessee is coffee bean. Is it? Benefit from substituting. Is it? Substituting the space. Because there would be minimal cost. Is that there would be minimal cost associated. Okay, the minimal cost associated with it. Is it? Now see the thing. He is changing the terms and conditions. Is that with respect to right of use of asset? Is it? This would. Is it? This would allow benefit economically. Is it? Economically from substituting the space. Okay, you have to mention the space because there will be minimum cost associated with it. Is it right? Minimum cost because there would be minimal cost associated . One minute. Just I repeated the same. Is it right? 1 minute. Yes, associate minimal cost associated with it. Okay. This would allow the operator to make the most effective use of its available space, thus maximizing profit. See, now you are understanding is that lessor has the right over the asset. Lessee doesn't have the right over the asset. Is it right? Lessor is having. If the lessor is having the right over the asset, very basic concept. If the lessor is having the right over the asset, then that contract is not going to be identified as a lease. Okay? That contract is not going to be identified as a lease. Okay? The contract is that the contract does not contain a lease. Okay, because there is no identified asset. We have to mention this. Is that you don't have a right over the asset. The coffee bean doesn't have the right over the asset. Very important. I am very slow here. Is that the coffee bean doesn't have the right over the asset. If you don't have the right over the asset, definitely you cannot treat that contract as a lease contract. Okay, that is with respect to test your understanding. One. Is it? Now, coming back to this second one. So you should understand what again they are saying. What is the requirement? See, in the examinations also you have to need. See, examination, your time management has to be. What I suggest is that whenever I am writing, you type it on the laptop, you are on your system. Is it right? It makes easy for you to practice and your fingers will move fast. Otherwise, time management, it's really very crucial for us to have a time management. Does the contract contains a lease? Okay. Now, what is the condition? That you should have the control over the right of use of asset. Understand? That's very, very important. You should have. AFG enters into a contract with Splash. Okay. AFG enters into the supplier. Who is the supplier? Splash. Means he is the lessor and he is the lessee. Is it correct? To use a specific ship for 5-year period. Okay. Divide the sentence in the examination also. Is that Splash has no substitution rights. Okay. There are no substitute. You cannot substitute. Okay. During the contract period, AFG decides what cargo will be transported, when the ship will sail, and to which ports it will sail. Means they have the control. Okay. They have the right over the asset. Okay. They have the right over the asset. They can say, yes, they have the right over asset in terms of what? In terms of when ship will sail, to which ports it should sail. Okay. What cargo should be transported. Fine. Now, however, there are some restrictions specified in the contract. They have mentioned some restrictions. These restrictions prevent. Okay, in the contract it is specific. They should not carry any hazardous materials. Okay, fine. That's well enough. That is very, very critical. Okay, significant as cargo, or from sailing into ships in waters where piracy is a risk. Okay, means you should not go to a unrestricted zones. You have to go within the defined way. Okay, stated way. Splash operates and maintains the ship and is responsible for the space passage of the cargo on the board and ship. Splash operates. Is it right? Splash operates and maintains the ship and is responsible for the safe passage of the cargo. AFG is prohibited from hiring another operator for the ship and from operating the ship itself during the term of the contract. When they say that, fine, there is AFG is prohibited, means you are in the contract with Splash. Definitely, you should not have another provider. Okay, define it is the things or not. Again, I am writing this. Okay, theory from my experience, my experience from my students, and the thing says that theoretically you have to be very, very strong. Okay, now what we have to do, we have to mention, is it right? AFG, is it? AFG has the right to control. Okay, right to control the use of the ship throughout the 5-year period of time. Because you have to give reasons for this. In the examination they will ask. Okay, it has what it says. It has the right. Okay, it has the right to obtain. Is it? It has the right to obtain substantially all of the economic benefit. That is what it says, is it not? You should have control over economic benefits. Okay, the lessee we should have control on economic benefits from use of the asset. Okay, use of the ship over the 5-year 5-year period. Okay, 5-year period. Yeah, due to its exclusive, is it? Exclusive use of the ship. Okay, yes, exclusive use of the ship throughout the period. Is it? Throughout the period of use. Now, what apart from that, what are the AFG is having? Is that AFG is having what are other things? So AFG has the right to direct. Is that right to direct? Fine. The use of the ship. Is that it has the right to direct the use of the ship. Is that all the contractual terms says that the ship can say where the ship can sail and where what cargo can be transported. Okay, this acts to define the scope. What is the scope? Means you have what is the scope of the contract we have to mention. Is it fine? Now, although contractual terms limit where the ship can sail and what cargo can be transported. Is it? This acts to define. Is it? This acts to define the scope. Okay, the scope of AFG's right to use. Okay, right to use of ship. Fine, right to use of ship. That's the most important thing. Is it? Now within the scope you can do anything. Okay, within the scope you can do anything. Within the scope, is it? Within the scope of its right to use. Is it right? It is AFG. AFG makes the relevant decisions. You just focus on these two. Test your understanding 1 and test your understanding 2. It gives you a complete comprehensive understanding. Is that next questions will be on calculation, but this is the most basic foundation. Okay, the relevant this, and students will find it difficult. First you have to identify that it is a lease or not. It is not a lease. After makes the relevant decisions about how and what purpose. Is it? About and for purpose the ship is used. Is it? Throughout. Is it? Throughout the 5-year period of use. Okay, because this is the most important thing. Is that this is what the lease IFRS 16 lease will be defined. Is that because it decides. Okay, because it decides whether where and when. Okay, where and when the ship sails, as well as the cargo, as well as cargo it will transport. Means See, this is what, if you are taking a car on a lease, okay, definitely I told you in the beginning what we have to do, what we should not do, where we can, or initially they will explain you in the contract, but you have the right to use the asset, is it? Now, what it says, the another concept says that splash, is it? Another says that splash, is it? Splash operations, is it right? Splash operations and maintenance, is it right? And maintenance of the ship, is it? Does not prevent AFGs from directing how, is it right? How and for what purpose the ship is used. It means you if you are saying that you are using the ship within the limited framework of the contract, fine. Nobody will ask you what you are doing, what you are not doing. Is it right? They will not as well as use the ship is fine. How and for what purpose the ship is used. Okay. Now, therefore, now you have to mention, is right? Therefore, based on the above, the contract is a lease. Is it? Based on the contract. Now what happens if you take into consideration, take the points, okay? The AFG is having what? AFG is having right to use, is it right? They have the right to use, is it right? And for a period of time, is it right? For how many years? Right to use for 5 years, okay? 5 years. And splash, okay? And the splash cannot substitute, is it right? Cannot substitute for an alternative, is it? For an alternative. Is it? These things has to be very, very clearly mentioned, okay? This means if you are following on these terms and conditions, definitely what will happen? We will say that whether it is a lease or it is not a lease as such. Okay? Now, at the commencement, what are the things we have to talk about? Lease, let's see accounting. At the commencement of the lease, at the beginning of the lease, IFRS 16 requires that lease recognizes a lease liability. Means you have to know, is it, what is the liability, what is the amount you have to pay, is it right? And what are the conditions with which we can use. The conceptual framework, most importantly, is it right? The SBR conceptual framework, you have to write in examination as per the conceptual framework. Marks will be given for that. Defines an asset as an economic resource that has the past event and is controlled by an entity. You have to, what is an asset? You should have, it should define that economic resources, that because something happened of the event, past event, you are going to have the economic resources and you have the control over the asset. That is what the control over the asset by the entity. Okay, if you don't have control, we cannot, means two things should go side by side. What is the right of use? Means this because lessee will determine the use of asset during the lease term. In the ship, in the previous case, is it right? In the previous case, the AFG, is it have the right to use the asset? Is it right? They have the right to use the asset as per the lease term. Okay, this will generate what? Definitely we are using the asset. It will some economic benefits. Very simple in terms of revenue. The lessor is unable to use the, means definitely once you are talking in terms of lessee, is it one and lessor, what happens that there will be a transfer. These are rights will be transferred to whom? Rights to use the asset will be rights of use of asset will transfer to lessee. In that period, lessor doesn't have any right over the asset. The conceptual framework defines a liability. What is you have to pay? Is that lessee has to pay the liability of a present obligation from the past event to transfer the economic resources. Is that economic? Is that by understanding it, say that it should be of a monetary value. Is that that's what it says? What is the liability? It is nothing but past event. You have to pay. You have to transfer the economic. A lease liability meets this definition because lessee has an obligation. You have the obligation to pay consideration. Is it right? To the lessor. Once the asset is made, consideration normally in the form of cash is a economic resource. When you are talking about economic resource, when you are talking about consideration, it should be in the form of cash or bank. But that's not the issue of that. Fine. Now these are the basic things we have to mean. You should have the liability component. Now is that you should have what is the right of use and lease liability. Going further, what will be there? The lease liability is right. The lease initially in the beginning you have to measure in terms of what? In terms of present value. When I am underlying these things, make it a point. It is going to be part of our understanding and our application. The initial liability, lease liability should be measured initially at what? At present value, okay, of the lease payments that have not been made. Means you have to work out on the present value basis. What are the things that the IFRS states? That lease payments include the following. Go one by one. You have a fixed payments, okay? You have variable payment that depend on the index or rate. Initially valued using the rate, index rate. Some means what is the inflation? Is it right? At or rate the lease commencement date. Is that if there is any variable changes because of the present values, definitely we should incorporate it. Amount expected to be payable under residual value guarantees. Is that's very specific. When you are talking into expect to be paid under residual value at the end of the lease period. Is that you have the options when you are taking the asset on a lease, you have the options to purchase the asset that has reasonable certain to be exercised. You have the option to purchase the asset at the end of the lease term, and if you are terminating the lease during the period, definitely there will be liabilities. There will be some penalties, okay? If the lease term reflects the expectation that the lease will be in termination penalties. Is that if they are saying that you are breaking the lease, you have taken it for 5 years, and after 3 years, in the middle of the lease term, you are going to discontinue the lease contract, you are going to cancel it, definitely there will be some penalties which you have to. What is the residual value? I have not explained here. Now I am explaining here. Is when the lessee is promised that the underlying asset at the end of the lease term will not be worth less than specified amount. At the end of the lease term, is that it will not be worth than the specific. Means if you are going to say that at the end of the lease term value is how much? At the beginning, is it? At the beginning of the lease, the value of the asset is $60,000. Okay, you have taken it for 5 years. Is it? After 5 years, okay, after 5 years, it is going to be how much? $10,000. Is it right? That the underlying lessor, is that is when a lessor is promised that the underlying asset of the lease, end of the lease term, will not be worth, is it right, less than the specified, means it will not be less than, means definitely it will be more than the residual value. That is what it says, residual value guarantee. When we are going to say that, yes, if the value at the end of the year, at the end of the lease term, the value of the asset will be more than the specified amount. That is the very, very simple residual value guarantees. Next, the discount rate should be the rate which the discount rate is, at what rate we have to discount the lease amounts in order to get the present values. If this cannot be determined, the entity should use the incremental borrowing rate. This rate at which it would borrow funds to purchase similar assets. Means definitely they will give us, okay, they will give us that what is the discount rate in most of the cases. Fine. Now, when you do the things, the right of use of us, the right of use initially, what are the conditions are there? You just take the example of a ship, is it right? IFRS says that the initial cost of the right of use of assets comprise the amount of initial measurement. Is that what we are doing here? We have mentioned the lease liability is initially measured at what? The initially measured at the present values. Is it the initially measured at the lease payments made or at or before the commencement date? Is it lease payments? Whether we are, see, there are two things. At the beginning of the year, at the beginning of the year, or we have to take at the end of the year. They will mention when the payments are happening, at the beginning of the year or at the end of the year. You have initial direct cost, anything we have to pay, the estimated cost of removing, dismantling, okay, at the end of the, as per the conditions of the lease, okay, the estimate or at the end of the lease. See, at the beginning you have any installation cost, at the end of the lease agreement there is any dismantling cost. These things has to be taken into consideration. Fine. That is the right of use of asset initially recognized at cost. They calculate the initial lies of the to calculate the initial value of the liability and right of use of asset, the lessee, okay, this has to be the right to calculate the initial value of the liability, the lessee must consider the length of the lease term. IFRS says that the lease term comprises of what? What is the lease term? It is a non-cancelable period. 5 years, 3 years, 4 years, 10 years, whatever it may be. Okay? Period covered by an option to extend the lease if reasonably, means you can have, initially you will say that it is for 3 years, is it right? And you can extend it, is it right? You can extend it for another 5 years, is it right? Means there should be have that flexibility, is it? You should have that option to extend, okay? Periods covered by an option to terminate the lease if reasonable certain not been exercised. Say period covered by an option, you have the option to terminate the lease. You can say that I will give 1 year notice and I will terminate my lease, okay? You should have the option both ways, okay? You have the options into both ways. But when you are doing this, definitely there will be some penalties. Is it? Definitely there will be some penalties. Fine. Now we will do this, and see, this will be in 3 or 4 parts, okay? Lease is a big chapter, okay? Fine. Next, what they are asking, first the examination concept is that first you have to understand what is the requirement, okay? That's very simple. Calculate the initial carrying amount of the lease liability and right of use of asset. Provide double entries needed to record these amounts in dynamic. Means you have to calculate initial carrying amount and the right of use with respect to double entry. General entries you have to provide with respect to dynamic financial records as such. On 1st January, okay, again you divide the things, okay, you divide the, on 1st January, Dynamic entered into a 2-year lease for a lorry. The contract contains an option to extend, okay, there is an option to extend for further 1 year, okay. Dynamic believe that it's reasonable certain to exercise this option. Means they are saying that yes, we are going to take the extension at the end of 2 years. Lorries have a useful life of how many years? 10 years. Okay. Lease payments are 10,000. Okay, per year dollars initial for the initial term, and 15,000 if you are extending it. There will be a. These are all in terms and conditions. All payments are due at the end. See, this is what very important. At the end of the year, to obtain the lease, the incurs initial direct cost is how much? 3,000. The lessor immediately reimburse 1,000 of these costs. The rate of interest, discount rate, is it right? Which is not readily determinable. The what is the dynamics internal similar type of assets? If we are taking, it is going to be 5% as such. Okay, 5% as such. Fine. Now, I will put it in 3 different stages. Okay, step 1, solution. Okay, this is the solution. Okay, see, you have to write. Okay, before writing this one, okay, you have to give. You have to see. The most important thing is just mention what is there. Is it the lease term? Is it right? The lease term is for how many years? Is 3 years. Extendable, okay? 2 years plus 3 years. We have to write this is because, is it? This is because the option to extend, okay? The option to extend the lease is reasonably certain. Is it right? They are reasonably certain to exercise. Fine. Now, what we are doing in the step 1? In the step 1, we are going to say that we will calculate the lease liability. Okay, we calculate the lease liability. Okay, as for calculated as follows. Fine. See the thing. Make it very, very clear when you are doing this. Okay, when you are doing this, make it very, very clear. And see, what I will is that do it on Excel. Okay, do it on Excel. They will nowadays they are giving structured format in the examination, in the computer based examination. They will give the format. We have to mention the amounts and the things. Is that discount rate? What is the discount rate they gave? Discount rate is at the rate of 5%. Is it right? We have to calculate the present value. Initial cost should be measured at a present value. This is one of the conditions they have mentioned. Is that when they have started 1st January. Means what will happen? 31st December 2001. Is it right? 31st December 2002 and extendable. Is it right? This is extendable, that is 31st December 2003. Okay, this is 31st December 2003 as such. Now, how much is the lease payments? Lease payments is 10,000. Is it right? Lease payment is how much? 10. Already I have put dollars. Okay, lease for the first 2 years. Whereas for the 3rd year, how much is the lease payment? 15,000. Is it right? 1 divided by 1.05 to the power of 1, 1 divided by 1.05 to the power of 2, 1 divided by 1.05 to the power of 3. Okay, this is column 1, this is column 2, this is column 3, and this is column 4. Column 4 is nothing but 2 into 3. Okay, if you take into consideration those things, how much we'll get? you will get first one is 9,524. Okay, it is in dollars. Okay, it is in dollars. Is that the second one is how much? 10,000 into 10,000 divided by 1.05 to the power of 2, it comes to 9,070. Okay, third one 15,000. This is the third one they have mentioned for the third year. If it is going to be extended, it will be for how much? For 15,000. So is it at 15,000 divided by 1.05? It comes to how much? 12,958. Okay. If you take the total of this, it will come to 31,552. Okay. This is the present value. Okay. This is the present value. What is the initial cost? Is it right? Initial cost is how much? You mentioned here. Step 2. Is it right? The initial cost. Is it right? The initial cost. You have the direct cost is there. You have reimbursements are there. 1,000 is there. Is that? You are paying 1,000. You are immediately reimbursing 1,000. Means you have to deduct 1,000 from that. Okay. The initial cost of the right of use of asset. Right of use of asset is calculated as follows. Okay, see, I am doing this in a different sessions. Okay, I am doing in different sessions, and next video will be continuation of this. Okay, next video will be continue. What is the initial liability value? Yeah, initial liability value is how much? Initial liability value is 31,552. Okay, this is the initial liability value. Okay, this is the initial liability. What is the direct cost? You have to add. Direct cost is how much? Direct cost is 3,000. How much is the reimbursement by the lessor? Less. Okay, reimbursement is it? Less reimbursement by the whom? By the lessor. Okay, by the lessor. How much is there? It is 1,000. Okay, it is 1,000. It will come to how much? It will come to 33,552. Fine. This is step 1. Is it right? This is step 2. Is it right? This will be step 3. Okay, this will be step 3. Step 3, what you have to do? You have to mention the double entries. Okay, you have to mention the double entries to record these. Is it right? These as follows. Is it right? Now, what is the things? See, we have the right of use of asset. How much is the right of use of initial liability? Is how much? 31,000. Is that? First, you have to talk about the initial liability. Is it right? We have to talk about the initial liability. Is it right? What will happen? You are getting the right to use. Is right? It is an asset for you. Debit will be what? Debit will be an asset. Is it right? Debit, right of use of asset. Okay, right of use of asset will be how much? 31,552. Credit will be what? Credit will be the lease liability. You have to pay. Okay, you have to pay when you are using it. How much? 31,552. Okay, next is that you have to mention it for the direct use also. Okay, you have to mention what is the debit. Is it right? Debit will be right of use. Okay, of asset. How much is there? It is 3,000. Is right? It is the cost. Okay, debit all expenses and losses. Okay, debit all expenses and losses. Credit will be what we are paying. Is it right? There is a cost. It is what? Debit. Credit will be cash. Debit, credit what goes out. How much? 3,000. You should be very, very strong in entries. Very simple. You have to be very strong in journal entries. Is right? That gives you additional mileage. What is the reimbursement? Is right? Reimbursement. What happened? You will receive cash. Okay, 1,000. Is it right? No. What will happen? Automatically the value of the asset will decrease. Is it right? Rights right of use asset. Is it right? Right of use of asset. How much? It will be 1000. Understand? Means this is the way the things has to be worked it out. Okay, you should make it a point. Understand the things. We have to make what is the step 1, what is the step 2, and what is the step 3. Make it a point. Here what we have done, we have initially calculated the liability right of use of asset at the present values. Then we have taken into consideration what is the cost of the initial cost of the right of use of asset as such. Okay, next. Coming to that, what is the subsequent measurements? Is right? See, here the carrying amount of the lease liability is increased by the interest charges. Any interest charges is there, we have to add it. Okay, any interest charges is there, we have to add it. Discounting is different, interest charges are different. This interest is also recorded in profit and loss account. Is that? Keep it in mind. What is debit? All expenses and losses, finance cost. Credited will be the lease liability. And at the end of the year, definitely what is the lease amount, what is the interest, what is the payment, and what is the closing balance. Is it right? You will have all the things. You will have you will have the opening balance. Is that? What is the lease amount? Is that? What is the lease amount? What is the interest? And what is the payments? Is it? What is the payments and what is the closing balance? Is it? This is the what is the interest? Okay, and what is the liability payment? Okay, what is the how much you are going to pay the liability, and you will have the closing amount. This is the way the carrying amount of the lease liability is reduced. How much you are going to pay your liability? It is reduced by the cash repayments. What will happen? The general entry is very important. Is that the liability will decrease. Whenever the liability will decrease, what will happen? You have to make it debit. Whenever the liability is increasing, we have to make it credit. Whenever the asset increases, it will be debited. Whenever the asset is decreasing, it will be credited. The right of use of is measured using the cost model unless another model is chosen. That we are based on the cost unless this means that it is measured in its initial cost less any depreciation and impairment losses. We are adding another features with respect to lease. Okay, means when we are talking in terms of cost model, it will be taken in the initial cost minus accumulated depreciation and in-loss. Depreciation is calculated when what it says ownership of the asset transferred to the lessee at the end of the lease term. Is that if it is transferred, the depreciation should be charged over the asset's remaining useful life. This is the condition. Okay, if the ownership is transferred, then what depreciation should charge with respect to assets remain. Otherwise, depreciation charge over the shorter use. If it is transferred, ownership is transferred, you have to what is our remaining assets remaining life. If ownership is not transferred, it is the charge is the shorter of the useful life of the lease term as such. Okay, means we will see. Keep it in mind. We will come into the things as we progress. If the lessee measures investment properties, always investment properties, okay, investment properties at fair value, okay, investment properties at fair value, then IFRS 16 requires that right of use of asset investment should be measured using the fair value model. If it is investment properties, mostly in terms of real estates. Is it? Mostly in terms of real estates. That's very, if it is going to be based on, if we are taking into consideration, the investment properties, we have to take into consideration which one? Fair values. Okay, we have taken consideration fair value. Now if the right of use asset belongs to a class of property, plant and equipment, then it is measured at a revaluation model. See, this is the basic difference. Okay, if it is investment properties, it has to be on fair value. If it is on property, plant and equipment, it will be on revaluation model. An entity may apply 16 IS 16 revaluation model to all rights of use of assets within the class. Is it within the class? This question follows from the previous test. You are explain the subsequent treatment of dynamic lease in the year ended 31st December 2001. Okay, now. Okay, 31st 12. Now, first what you have to do, we have to take those things. They are talking about the interest factor. Is there interest charges? How much is the interest? They say the borrowing is how much? The borrowing is 5%. Okay, the borrowing is 5%. Only for 1 year they are saying. Okay, only for 1 year they are saying. If they are saying is for 1 year, is it right? If they are going to say it for a 1 year, we have to first what we have to calculate. We have to calculate the interest for 1 year. Okay, what is the interest? What is the they have mentioned what is the initial liability value? 31,552. Okay, solution. Is that I will put in the same way. Okay, the first one is step 1. Okay, the first one is step 1. Fine. Next, we have to see initial liability value. Is that initial liability value is how much? 31,552. Borrowing cost is how much? Borrowing cost is how much? Simple. It is not debit. Borrowing cost is 5%. Okay. For interest will be how much? Interest will be only for we are taking for what? We are taking for 31st December 2001 only. They have mentioned here. Okay, they have mentioned here 31st December 2001 only. Is that interest will be how much? 31,552 times 0.05. Okay, it comes to how much? It comes to $1578. Okay, now for this you have to mention the journal entry. Okay, for this that's very important. Journal entry. What will happen? They have mentioned here. Is it right? They have mentioned here. Here they have mentioned debit is finance cost, credit is lease liability. Okay, debit is how much? Finance cost. Finance cost. Okay, profit and loss account. Profit and loss account. How much? 1578. Credit will be what? Credit will be lease liability. Is it? Credit will be lease liability. How much? $1578. Okay. Is it? 1578. At the end of the year, is that they will make a cash payments. How much they are paying cash payments? 10,000. Okay. At the end of the year, they are making a cash payments of how much? They are making a cash payments of what it says. Even because of the carrying amount of the lease liability is reduced by cash repayments. Okay, lease liability debit by cash. Okay, step 2. Fine. Step 2. What is the cash payment? Is it right? Cash payment reduces lease liability. How much is there? How much they are paying? They are paying 10,000. Is right? Debit will be liability. Debit will be liability. How much? 10,000. Is it right? Credit will be cash. Okay. How much? 10,000. Is it right? Debit will be. Now, just I do a small working here. Okay, I will do a small working here. Is that working 1? Okay, working 1. I will do a small working 1. Okay, working it just to make is that lease lease liability table. Is that lease liability table? What will happen? First one is year ended. Is it right? First one is year ended. The second one is opening balance. The third one is, I have mentioned interest. The fourth one is cash payments. Is it right? The fourth one is cash payment. The last one is closing balance. Is that? Put the numbers. It will be easy for us. This is 1. This is 2. This is 3. This is 4. This is 5. 5 is nothing but 2 plus 3 minus 4. Okay. 2 plus 3 minus 4. We want to know how much is the current liability and how much is the non-current liability. Is it right? We have to give how much we are going to take that into consideration. Fine. Now year 1 is it 31/12/2001. Opening balance is what is the initial lease liability? Initial lease liability is 31,552. Is it right? How much is the interest we have calculated? 1578. How much is the cash payment? We are paying 10,000. Is it right? What is the 2 plus 3 minus 4? Is it right? 2 plus 3 minus 4, how much? 23,130. Is it? 31/12/2002. Okay. How much is the opening balance? 23,130. Is the interest at the rate of 5%. Okay. Interest at the rate of 5%. At the rate of 5%. Okay. How much will come? It will come 1157. Okay. 1157. How much you are paying? We are paying 10,000 as cash payments. Okay. How much will come? It will come to 14,287. Is it right? 14,287. Fine. Now we have to make, this is the working one. Okay. This is the working one as such. Now coming back to this. Okay. Coming back to this. What we are the, how much is the closing balance at the year 1? The closing balance at the year, at the reporting date means, see the thing, reporting date. Okay. Reporting, this will come, reporting date will be always the end of the year. Is it right? Reporting date is always the end of the financial year. Okay. Reporting date, this is a general understanding we have to keep all the time. Okay. This is the general understanding we have to keep all the time also. What we have to mention? The liability has the carrying amount. The liability has a carrying amount. How much is that amount of $23,130 at the reporting date? Okay. At the reporting date, with they are asking only for 31st December. Is it right? Of this. Is it right? Of this, what is there? 14,287. Is it right? 14,287 is for the next year. Okay. Of this, how much is there? See, total amount is 23,130. Is it right? Of this 23,130 minus 14,287. Is it right? Is it right? Otherwise I will put like this. 1 minute. Otherwise I will put like this. Of this, the liability has the carrying amount. Is it right? 23,130 at the reporting date. Of this, how much? 14,287. Okay. 14,286 is for the next year. It is not for the current year. Is it right? It is for the next, is a non-current liability. And how much is the current liability? Is that how much is the current liability which they have to pay? We have to pay how much? 23,130. Is that 23,130 minus to 14,000. You have to remove the non-current liability component. Okay. How much it will come to? How much it will come to? 8,843. Is it right? Is current liability. is it? We have to from the to carrying amount at the reporting date, we have to remove the non-current liability, and the balance will be the current liability. Fine. Okay. Next. Yeah, this is step 2. Notice the step 3. Yeah, the right of use is depreciated. Is it? The right of use asset is depreciated. They are saying that it will be depreciated, is it? Over the 3 years life, 3 years lease term. Okay, 3 years lease term. Yeah, because why it is they say that they have mentioned here. It is right. Dynamics incremental of the borrowings, and believes it is reasonable, certain to exercise the things, and dynamic interest fine. Okay, the rate of interest. It is for a shorter term. Is it right? Means we have to take into consideration the depreciation factor also. How much is the total value? The total value is how much? The initial cost is how much? Initial cost of right of use is how much? It is 33,552. 33,552 divided by 3. Okay, 33,500 divided by lease term, because it is shorter than the useful life. The useful life is 10 years. Okay, the useful life is 10 years. Sorry, the useful life is 10 years, and we are using for how many years? We are using for 3 years. Okay, the total life is useful than the useful life. Again, I am saying the useful life is 10 years. We are using it for only 3 years. Okay, 3 years. This gives, is it? This gives a charge of how much is the total? 33,552 divided by 3 years. Okay, it comes to how much? It comes to 11,184. Okay, 11,184. You have to write a journal entry for that. Okay, you have to. They say journal entry is very important. Is that what you have to write? Journal entry. Debit is depreciation. It is an expense. Okay, or profit and loss account. Okay, profit and loss account. How much is there? 11,184. Is that? Credit will be what? Your value of the asset will decrease. Okay, right of use asset. Is that right of use asset? How much? 11,184. Okay, is it? Now, what is the carrying amount? The carrying amount, is it? The carrying amount of the right of use asset, is it right? Right of use asset will be reduced by what? Will be reduced to how much? 33,552 minus 11,184. It comes to how much? It comes to 22,368. Is it right? This is the way we have to work it out whenever we are thinking in terms of lease payments. Okay, means when we are talking in terms of the right of use, and whenever there is a shorter period of life. See the thing, if it is a shorter, now you can say depreciation is charged over a shorter of the useful life, and the lease term as previously defined. Okay, means you have to make a judgment. Okay, if it is life, and we have to compare, and mostly it will make some sense as such. Okay, now this is what this is for this session. Okay, I have explained you the concept of lease, and I explained you how whether it is a lease contract or it is not a lease contract. Then we say how we have to calculate the initial value, and for everywhere there should be general entries will be there. Okay, and subsequently we have to take into consideration the if there is any finance cost, we have to take that into consideration. Okay, this is with respect to this session. Okay, I kindly request you to subscribe to this channel, share this channel, and your comments, any doubt, just post it on the comment section. I will get back to you. Okay, with when we are coming back for the next session, we will start with separating components. Okay, thank you so much. Take care.